All right, first problem of the second set. Takeaway from this question is that when we have two different or multiple temporary differences, we need to account for the assets and liabilities separately. That would be the largest takeaway in this question for me. And let's go ahead and get into it and figure out what the journal entry needs to be at the end of this year. They said at the end of year one, these are the balances. Nothing existed at the beginning. And so here we go. We're going to determine the deferred tax asset. What we're going to do is figure out what the balance needs to be. We know the balance equals 0 now. And it says that warranty expenses, which is what's going to, the deferred tax asset's going to come about from that, is $13,000. And then in order to figure out what the balance needs to be, I need to take that times 0.25. And so this equals $3,250. And that is my adjustment. And let's go ahead and write down our journal entry, tax expense. We're going to back into. We just know the deferred tax asset. We know what that is. That's $3,250. And now what I'm going to do is come over here and figure out what the deferred tax liability needs to be. All right, so the deferred tax liability starts out at 0 because this is the first year. The balance needs to be these two things put together, which is going to be $83,000 times 0.25, which turns it in. And that is my adjustment as well. All right, and that would be for $20,750. And the last thing that I'm going to do before I get tax expense is to do taxes payable. And that's this. And how I'm going to do that is we're going to take taxable income, which is $16,000 times 0.25. It's going to tell you what taxes payable are. So taxes payable are $4,000. And now I can back into tax expense. It's just going to be a product of these two minus that, and that's going to give us $21,500. Main takeaway: keep assets and liabilities separate and set them up like this.